Hello, welcome back to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching. I greatly appreciate the time and the support. This channel is dedicated to rational investing, where we look for the hunt for cash flow, and we use that cash flow to figure out what the intrinsic value of a stock is. We compare the stock to the market value, and we figure out if we believe there's a return to be made by watching the intrinsic value come up to the market value. In this channel, we look for 5 key attributes for all of our stocks. First, we look for stock that has growing revenue. We look for a stock that has growing earnings, as we define it by EBITDA, debt level less than 3, well-priced stock, and a strong free cash flow. Those are the 5 attributes that we look for. Today's episode, we're going to look at Microsoft Corporation. As everyone knows, Microsoft is a behemoth in the digital space. So let's take a look at their numbers and see how they stack up and see where the value is. Before we get started, I want you to read the 10Ks, right? Behind me is their annual filing. Microsoft's fiscal year ends in June 30th. So for those who don't know, you can have a fiscal year, which is different from calendar year. Microsoft uses the 12 months ending in June 30 as their full year. So this being June 2020, they're just wrapping up their 2020 fiscal year. It's not out yet. So I'm using the 2019. There is 3 quarters of extra information out there in the world. Please go read that. I have not taken the time to add in those 3 quarters and forecast the extra quarter for the year. I just look at the full year because we're holding for a long time. Okay, let's dive right in to Microsoft. So behind me is roughly 10 years of their revenue, EBITDA, and the enterprise value. So we're going to look for the first 2 key characteristics: growing revenue, growing EBITDA. Let's take a look at revenue first. So revenue in 2011, Microsoft had roughly $70 billion of revenue and have grown that over that time frame to $25 billion, with most recently a very large increase in revenue from $90 billion to $125 billion. Over the 10 years, it's averaging out at 8% annual revenue growth, which is fantastic. It's a strong single-digit number from a very, very big corporation, which is difficult to do. And it's one of the hallmarks we look for: strong revenue growth. They have it. Let's look at EBITDA. We're going to pick up with earnings before interest and tax. We'll add back the non-cash charge that is amortization and depreciation for an EBITDA. A reminder, EBITDA is our proxy for cash earnings at the enterprise level. That means you bought the entire company debt-free. This is the cash that you would get. They lifted the business earnings from $29 billion to $52 billion over that roughly 10-year decade period. That's an annual growth rate of 10% a year. This is great to see. This is large. First of all, it's growing. Excellent. Second, the 10% is bigger than the 8% revenue. That means margins are growing as well. Excellent to see. Let's figure out the enterprise value, and then we can use a market multiple to figure out what the pricing is, how expensive are these earnings relative to the market and relative to what it's been in the past. We begin with debt. Now we want to figure out all the long-term and short-term obligations that the Microsoft or any company would be responsible for. So this is pensions, this is capitalized leases, this is bonds, convertible bonds, any of that stuff. It also includes the short-term component of that. And you need to be careful. There's a lot of people, there's a lot of websites that will look for debt, but they won't include the current portion of long-term debt, which is missing a big chunk of the debt piece. So you want to make sure you grab that too. Microsoft also has a tremendous amount of cash on hand. They have $122 billion of cash, which is huge. And that's more cash than they have in debt outstanding. So their debt is effectively zero if you net the cash with the debt. Market cap is shares outstanding times price. We add those up, add debt, market cap, less cash gets you the enterprise value. Now we get to the story of the enterprise value and their expensive relative, or are they expensive or cheap relative to the company as a whole. Enterprise value has gone from $195 billion to $1.2 trillion at the end of the fiscal year last year, June. Now, if you remember earnings, EBITDA went from 30 billion to 50 billion. That's roughly 2 times, a little less than 2 times growth. Enterprise value going from 195 to 1.2 trillion. That's roughly six mental math, 6 times. So earnings go up by 2, business value goes up by 6. What's going on here? Well, what's going on is the market is becoming a premium. That the market multiple, you could buy that cash flow a decade ago for 6.7 times earnings, which is cheap for, at the time, a $200 billion corporation throwing off $30 billion a year in earnings. That's very, very cheap. And what happened is they figured out how to grow, and then boom, the market multiple expands from 6.7 to 21, call it 22 times. And the appreciation you get in the stock price is partly due to earnings, but earnings only almost doubled. What's going on is all the people driving into Microsoft buying the growth is causing the market multiple expansion. That generated most of the return in the last decade. So it sits at 21, right now it sits at 28 times. If I take the current price, prior EBITDA and debt load, that's 28 times EBITDA. So now what? Does it go to 50? It's gonna hurt the return in the long run. Is this 28 is gonna have to come back down to something more market, say 20, say 18, something in the range. This is averaged over that time 15. So if it reverts back to the mean, it's gonna put downward pressure on the price. But enough of that. So that's enterprise value to EBITDA. Looks like it's a little rich. On the debt side, this calculation is actually just taking total debt, long-term debt, divided by EBITDA. What we should be doing is netting cash. So when you look at this, you're thinking there's 2 times debt to EBITDA. What I didn't do, it's not in here, is I'm not netting the cash. So in reality, their debt load is 0. Because this cash here, $122 billion, is more than the 95 they can just pay cash for all their debt and they're done. So very, very strong balance sheet. Strong revenue growth, strong earnings growth. Those are 3 hallmarks that we look for. Microsoft checks all those boxes. Let's go look at cash flow, and then we're going to, we'll forecast forward to what the value is. Okay, cash flow from operations. This is cash money that Microsoft generates on an annual basis by selling their software. So it's different from earnings. Earnings, right, could be paper. It's by paper I mean it's not cash. It's on paper. It's printed. The earnings. But cash is cash. Cash is receiving payment from customers. It's paying bills later, so you preserve more cash. It's the day-to-day running of the business, and it's critical to look at this. And what we look for is we want to make sure that the cash flow from operations is growing in line with EBITDA, because that means that the accounting department at Microsoft is treating cash as it should be and treating earnings appropriately so they match. If you see disparate change here where earnings are growing but cash is going down, then someone's playing with the books. You go back and look at your Enron cases, people like that. When you start seeing large divergence between cash flow and earnings, something's going on. This here checks the box. It's great to see. Congratulations to the accounting team at Microsoft. Next thing is CapEx. So CapEx, sorry, I didn't actually recap cash flow from operations. So they go from 27 billion to 52 billion, almost doubling, in line with the EBITDA, 9% annual growth, fantastic. CapEx is the reinvestment that they need to do every year to maintain that cash flow in the business. So it's new server farms for Microsoft, it's new offices and buildings and infrastructure. It's not acquisitions of new companies. This is just maintaining what they currently have. And what we would like to see in this channel is a wide margin between the cash flow from operations and the CapEx, because the CapEx is required to maintain this cash flow. So every year they generate cash, they have to reinvest a little bit. And what's left over is what they can keep for us, or in this case, pay debt service and whatnot. But you want to look at this difference between the two, and that needs to be big. And in Microsoft's case, it is large. Debt payments, it's kind of trivial. We know they have enough cash in hand to wipe all the debt debt clean. So that's really, really low. And then what happens is this free cash here, the cash flow from operations minus CapEx, passes through to cash flow to equity, free cash flow to equity, and it's large. And it's very nice to see. It's extremely strong every year, and it means that they generate a tremendous amount of cash, and that is a moat. That is a fortress. It's defensible. They're not going out of business anytime soon. This is where you can put your money, and you can feel confident that over the long term, they're not going to go out of business, and they're not going to destroy value. And that's a very, very good thing. Outstanding shares. So if you look over this time period, you'll see that the shares have shrunk about 1% annually over time. And that's good. That means that you buy shares today. In the future, you own a greater percentage of the business. Cash flow per share, free cash flow per share. I'm just dividing cash flow by shares. Stock price at the end of the fiscal year, June. And the yield. Yield is free cash flow equity per share divided by price. And the growth rate of the free cash flow itself per share. And that has been on average 13.6% or 14%. Strong double-digit growth. So let's go back to our check boxes. We've got revenue, check, earnings, check, low debt, check, strong free cash flow, absolutely. So the boxes here are all checked, but the fifth is the well-priced stock. So we want to see what that looks like. Next thing we need to do is we need to forecast the price. So what we're going to do is we're going to go forward and we're going to forecast free cash flow. Here I'm picking up my estimate for cash flow in 2020 would be $5.15. Again, I'm just taking the annual numbers and dragging them forward. You can pull the Qs, stencil it together, and you'll get a more accurate number. But if we're holding this for 10 years, I'm just proxying the number. They're going to grow it on average 10% per year over that time frame, starting with about 15%, which is the average of the last couple years. And I'm going to bring down the growth rate over time as a cushion for the unknown of the future. I don't want to take the 15% and string it all the way out. It's giving too much credit to Microsoft, and you end up paying that in the price. We want a nice conservative case, and I think this is a conservative case for the corporation. That gets you a $300 price target in 2029. I'm using a 4% yield. If I go back to the yield over here, you can see the yield over time has come down. When the stock was cheap at 6.7 times EBITDA, the yield was 11%. Fantastic time to buy. By the way, if you're value hunters out there, Microsoft at the time, $200 billion of enterprise value, $30 billion roughly of EBITDA, throwing off 11% of cash flow. That's a great time to buy. Had you done that, you would have also had the market multiple expansion over the decade as they figured out how to grow, and you would have tremendous return. That has come down as the price appreciation. Your yield has fallen. They're paying 2.9% right now. I'm using 4% as the long-term average. That's kind of what we use at the channel, 4 or 5%. That gives me a $300 price target based on the cash flow method. Let's go look at market multiple and EBITDA. We'll get a different estimate of the value. All right, let's use the EBITDA method to value Microsoft Corporation. So what we're going to do is we're going to pick up from 2020 the EBITDA estimate of $63 billion. And that's just a 20% growth rate on prior year's EBITDA. And I string it forward, decreasing the growth rate over time to average about 11% over the decade. That estimate gives me roughly $150 billion of EBITDA in 10 years. I've assigned an 18 times market multiple to that EBITDA. And that's less than the current 28 times. So definitely coming back down closer to the average. Not as low as it used to be at the 14 times, but not nearly as high as it currently is. That puts a enterprise value at 2.6 trillion. Less debt plus the cash gives you a market cap of 2.8 trillion. Shares outstanding 6.2 that'd be billion, 6.8 billion, excuse me. And this is subtracting a few 1% shares every year, like they have been historically, to come with a forecast share value. And then that makes a price of $412. So now we have two price estimates. You have a free cash flow method, which says 300, and you have an EBITDA market multiple, 400. Two different methods. We're going to average the two because we don't know what's right. We're going to say $350 is roughly the price target for Microsoft in 10 years. You've got a current market price of $200. Let's plug that into our handy dandy IRR calculation, figure out what that return looks like. And you can see here a market return of about 10%, which smells about right. Let's go through the cash flows, then we'll talk about the return. So I'm in at $200. I get the cash flows here, which is basically if you own the entire business, you would be able to distribute all the cash out. This is not the dividend yield that you would get normally. It's all cash that's available to be distributed. The thinking here is that if Microsoft retained that cash, they should be able to reinvest it at a higher rate of return than this 10%, and therefore you'd have upside for all the dollars that they kept. So it's kind of like a base case where it says all the cash is just distributed. They're not making any more acquisitions. They're just going to be a dividend machine. That's kind of what you get. And you get kind of natural appreciation what's built up in the pipeline. So then you exit the business at 350. You get this cash flow over time, and it's roughly 10% IRR. And that's a 2.2 times cash on cash return. And to me, that smells about right. Microsoft is extremely popular in the market, and the market as a whole has run up post-COVID. We've experienced the V recovery, at least the stock market has. The economy as a whole still has a lot of unemployment. Still, it's going to take more time to recover. The market seems to be a little ahead of itself. So diving in at this point in Microsoft seems to me that you could expect a market return, which is roughly 10%. I think that's what people are predicting going forward, that we're fairly fully priced. And Microsoft being a big piece of the S&P 500, that makes sense to me. Let's take a look at a distribution. If the stock price does swing from your 200, it comes back down to where it was previously, is a great deal, or goes up higher, what do you want to do? Okay, so it's 10% now. Again, market return, not beating the market, but it's decent, certainly safe. If you're even a retiree, you want a little bit of growth with some dividend, this is a decent place to put cash. As it comes down, if it does come down again, excellent buying opportunity. And then as it goes north, you're going to sink into the single-digit returns. And I'd wait on it if it's above 200 for sure. So in terms of a score, this channel, you know what we're looking for. I'm going to give it a meh. All right, why? Let's review our criteria. Revenue growth, yes. Earnings growth, yes. Free cash flow, absolutely. And low debt, all of those, yes. Well priced, not for us, right? What I'm looking to do, what this channel is looking to do, I'm looking to beat the market. I'm looking to find companies that have all 5 criteria, not 4 out of 5. You know, Microsoft buying it at the decline when everyone's freaking out was a great time to buy. Now that it's recovered, you got to think, meh, there's probably other opportunities out there, and while we hunt, we'll let Microsoft do its thing, and if for some reason it should sell off again, we would look to buy it. But right now, I think we're going to continue hunting. There's better value out there in the world, and we're going to pass for now, even though the corporation itself is stellar, and I'd love to buy it. I just think 200 for me, and the IRR that I'm looking for, it's not it, and I'm going to pass. So that's why I give it the meh. My name is Cameron Stewart. I hope you liked this presentation on Microsoft. Let me know what your thoughts are in the comments. Don't forget to hit the subscribe button. I greatly appreciate that, and see you in the next video. All right, cheers. Bye-bye.